Imagine this. You've been paying your mortgage for years, and suddenly you realize your home could actually be hiding something valuable, something that could fund your dreams, pay off debt, or even start a new business. But here's the big question. Should you really tap into it with a home equity line of credit, or could it backfire and cost you big time later? Let's break it all down so you know exactly what you're getting into before making a move that could either be smart or scary. Number 1. What a home equity line of credit actually is. Think of a home equity line of credit, or HELOC, as a credit card, but backed by your home. Instead of borrowing a lump sum like with a regular loan, you get access to a revolving line of credit you can draw from whenever you need. Here's how it works. The bank looks at how much equity you have in your home, meaning the difference between what your house is worth and what you still owe on the mortgage. For example, if your home is worth $400,000 and you still owe $250,000, you have $150,000 in equity. Most lenders will let you borrow up to around 80 to 85% of that equity. So you might qualify for a HELOC of about $120,000. Sounds great, right? You can use that money for anything: home renovations, college tuition, or even paying off credit cards. But don't celebrate yet. There's a catch, and we'll get to that soon. Number 2. How a HELOC differs from a home equity loan. Many people confuse these two, but they work very differently. A home equity loan gives you one lump sum of money up front, and you start paying it back right away with fixed monthly payments. It's predictable, same payment, same interest rate. A HELOC, on the other hand, is flexible. You can borrow, repay, and borrow again during what's called the draw period, which usually lasts about 10 years. You only pay interest on what you use, not the full limit. For example, if you have a $100,000 HELOC but only draw $10,000, you only pay interest on that $10,000. That's the beauty and danger of it, because it feels like easy money. Number 3. The two phases of a HELOC. A HELOC has two key stages: the draw period and the repayment period. During the draw period, usually the first 5 to 10 years, you can use the money as needed and often only pay interest. It feels manageable because the payments are small. But after that period ends, you enter the repayment phase. Suddenly, you can't borrow anymore, and now you must start paying back both the principal and interest, which can make your payments shoot up dramatically. Imagine paying $200 per month during the draw phase. Then suddenly it jumps to $700 once repayment begins. Many homeowners get caught off guard here. Number 4. The advantages of a HELOC. Now let's talk about why so many people love HELOCs. First, flexibility. You can borrow only what you need when you need it. It's perfect for ongoing expenses like remodeling projects or tuition payments spread over several years. Second, low interest rates. Because a HELOC is secured by your home, lenders often offer lower rates compared to credit cards or personal loans. Third, possible tax benefits. In some cases, the interest you pay may be tax deductible if you use the money to improve your home. But always check with a tax professional before assuming that. For example, if you use your HELOC to remodel your kitchen, you might be able to deduct the interest. But if you use it to buy a boat, not so much. Number 5. The hidden risks you must know. Here's where things get real. Since your home is the collateral, if you can't pay back the loan, you risk losing your home. Yes, the very roof over your head. Another risk is variable interest rates. Most HELOCs come with rates that can go up or down depending on the market. That means your monthly payment could increase even if you don't borrow more. And then there's temptation. Many people treat HELOCs like free money and start funding vacations, luxury cars, or unnecessary expenses. But remember, you're literally borrowing against your home to do it. During the 2008 housing crisis, many homeowners faced foreclosure because they used HELOCs carelessly. When home values dropped, they owed more than their homes were worth. That's a nightmare scenario you want to avoid. Number 6. When a HELOC makes sense. Used wisely, a HELOC can be an amazing financial tool. If you're using it to increase your home's value, like finishing a basement, upgrading a kitchen, or adding energy-efficient improvements, it can actually boost your equity and pay for itself over time. Or maybe you're using it to consolidate high-interest debt. Paying off a credit card charging 25% interest with a HELOC at 8% can save you thousands. However, the keyword here is discipline. If you don't change the habits that caused the debt in the first place, you'll just end up in deeper trouble later. Number 7. When a HELOC is a bad idea. A HELOC is not for everyone. If your income is unstable or you're already struggling with debt, adding another line of credit could make things worse. It's also a bad idea if you plan to sell your home soon. Because the loan is tied to your property, you'll have to pay it off when you sell, which can cut into your profit. And if you're using it for things that don't build wealth, like vacations, weddings, or shopping sprees, that's a red flag. It's like burning money you don't have yet. Number 8. How to qualify for a HELOC. Lenders will look at several factors to approve you. They'll check your home's value, your credit score, your income, and your debt-to-income ratio. Most lenders want to see a credit score above 620 and at least 15 to 20% equity in your home. They'll also consider your ability to make payments even if interest rates rise. So having a steady, reliable income helps a lot. For example, if your home is worth $400,000 and you owe $300,000, your equity is $100,000. A lender might allow you to borrow up to $80,000, depending on your credit profile. Number 9. How to use a HELOC wisely. Here's where strategy comes in. Treat your HELOC like a tool, not a paycheck. Use it for projects that either grow your wealth or reduce your costs, not for things that lose value over time. A smart homeowner might use a HELOC to build a rental unit on their property, generating monthly income that helps pay off the line itself. Another might use it to refinance high-interest debts, saving hundreds per month in interest. But always have a repayment plan before you borrow. Because remember, it's not free money. It's your home on the line. Number 10. What happens if you can't pay it back? This part's uncomfortable but important. If you fall behind on your HELOC payments, the lender can foreclose on your home, just like a regular mortgage. Before it gets that far, you might face late fees, damaged credit, or even frozen access to your credit line. In extreme cases, if home values drop and you owe more than your house is worth, you could end up stuck with a huge financial burden. That's why experts recommend borrowing only what you truly need and having an emergency fund as a backup. Number 11. The alternatives you should consider. Before jumping into a HELOC, consider other options. If you just need a lump sum for one-time expenses, a home equity loan might make more sense. If your project is smaller or short-term, maybe a personal loan is better. And if you're thinking about debt consolidation, explore balance transfer credit cards or refinancing your mortgage. Each option has pros and cons, but the key is to pick the one that fits your goals without risking your home unnecessarily. Number 12. Understand how interest rates work. HELOCs usually come with variable interest rates, which means your rate can change over time. The rate is typically based on the prime rate plus a margin set by the lender. For example, if the prime rate is 8% and your lender adds a 1% margin, your HELOC rate would be 9%. If the prime rate rises, your rate could increase too, which means your payments can become more expensive. Some lenders offer a fixed rate option for part of your HELOC balance, which can help protect you from rising rates. Always ask your lender if they offer that flexibility. Number 13. Know the fees before you sign. A HELOC may sound simple, but it often comes with several hidden fees. You might pay an application fee, an annual fee, an appraisal fee, or even closing costs. Some lenders also charge early termination fees if you close the account within the first few years. For example, if your lender charges a $500 annual fee and a $400 appraisal fee, that's $900 gone before you even borrow a single dollar. Always ask your lender for a complete list of costs before agreeing to anything. Number 14. Pay attention to the fine print. Many HELOC contracts have details that can surprise you later. For instance, some lenders reserve the right to freeze or reduce your line of credit if your home's value drops. Others may require minimum withdrawal amounts or limit how often you can borrow. That's why it's crucial to read every page of your agreement and ask questions if something doesn't make sense. Don't just rely on what the loan officer says. The details in writing are what truly matter. Number 15. Plan for the end of the draw period early. A common mistake homeowners make is waiting until the repayment phase hits to prepare. If you only make interest payments during the draw period, your principal balance stays the same. When repayment begins, that full amount suddenly becomes due, leading to payment shock. Start paying more than the minimum during the draw phase to reduce your balance before repayment starts. Even paying an extra $100 a month early can ease the transition later. Number 16. Think about market conditions. The real estate and economic environment can affect how valuable a HELOC is for you. If home values are rising, a HELOC can be a smart way to access your equity. But if prices fall, you might end up owing more than your home is worth, a situation known as being underwater. For example, if your home's value drops from $400,000 to $300,000, but you owe $320,000 including your HELOC, you're in trouble. Timing matters, so it's wise to consider where the housing market is headed before borrowing. Number 17. Protect yourself from overspending. A HELOC gives you easy access to cash, and that convenience can be dangerous. It's tempting to swipe your HELOC debit card or write checks without thinking about repayment. To stay disciplined, set strict limits for yourself. For example, decide upfront that you'll only use your HELOC for home improvements or emergency expenses, nothing else. Treat it like a last resort tool, not an everyday account. Number 18. Check how your credit score affects your rate. Your credit score plays a big role in what interest rate you get. A borrower with excellent credit might get a rate of 8%, while someone with lower credit could be charged 11% or more. That difference could cost thousands over the life of the loan. Before applying, check your credit report for errors and work to improve your score. Pay off small debts, lower your credit utilization, and make sure all your bills are current. Even a small boost in your score can mean a much lower interest rate. Number 19. Understand the impact on your credit. Opening a HELOC creates a new line of credit, which affects your credit report. Initially, your credit score might drop slightly due to the hard inquiry from the lender. But as you use and repay the HELOC responsibly, it can actually improve your credit over time. However, if you max it out or miss payments, your credit score can take a big hit. Keep your utilization low and make every payment on time to maintain a strong credit profile. Number 20. Have an exit strategy. Before taking out a HELOC, decide exactly how and when you plan to pay it off. If your income increases, you might make extra payments to pay it down faster. If you plan to sell your home in the next few years, make sure you know how much of the HELOC you'll need to clear before closing. Having a clear repayment strategy helps you avoid last-minute stress and keeps you in control of your finances. So, should you get a home equity line of credit? The answer depends on how disciplined you are and what you'll use it for. A HELOC can open doors to opportunities or open a trap you can't escape from. Use it wisely, and it can be one of the smartest financial moves you make. Use it carelessly, and it could be one of the most painful. Now tell me, if you had access to a HELOC today, what would you use it for?